The Dow Jones, Nasdaq, and FTSE 100 are three of the major stock indices that play a hugely important part in our financial world. Yet a stock index is nothing more than a number representing the top shares of a particular exchange. Take the FTSE 100, for example. It represents the largest 100 companies traded on the London Stock Exchange. If on average the share price of these companies goes up, the FTSE 100 will rise with them. If they fall, it will drop. Now, in the US, along with the Dow Jones and Nasdaq, you also have the S&P 500. In Europe, there's the DAX and the CAC. And in Asia, the Hang Seng, Nikkei, and S&P ASX. Most of these stock indices are calculated using a capitalization-weighted average, which means the size of each company is taken into account. The more a particular company is worth, the more its share price will affect the index as a whole. The Dow Jones and Nikkei, on the other hand, are an example of price-weighted indices. This means shares with higher prices have more influence. A stock trading at 100 yen is given 10 times more clout than one at only 10 yen. So, now you know what stock indices are, how can you trade them? Well, since indices are simply numbers, you can't buy or sell them directly. You must choose a product that mirrors their performance. Products that track the price of the underlying index include index funds, exchange-traded funds, futures, options, and CFDs. And because indices are made up of so many stocks, the value is always shifting. Many indices are often more volatile than individual shares. This provides traders with multiple opportunities, but also increased risk. So, remember, when trading stock indices, it's important to do your research and use risk management tools where appropriate.